December 2017, where we have a company called W as per note number 1, additional note 1. W has 60% in S, and as per note number 3, it has got 90% in F. So both of these companies, given the significance of the shareholding more than 50%, both of those companies are who are subsidiaries of W. And if that is the case, that is the first working that you should do. Establish the group structure. Once you have known that these are your subsidiaries, please go ahead to consolidate, and this is where we are. So the name of the company is W Group, Consolidated Statement of Comprehensive What Year Income. Fortunately, the two companies that we have here happens to be what year? They happen to be our subsidiaries. So you're going to consolidate line by line. We are going to consolidate line by what year? Line by line. We're going to consolidate line by line. So line by line is quite a simple thing. So I'll come and talk of revenue. The way I've been given their revenue, ladies and gentlemen, the first one is 976 plus. We have 420 plus. Consolidation is quite a simple thing. I'm only adding 63. For the sake of the students that are just joining us, we studied this question quite earlier and we forgot to record. This W Limited acquired S Limited 1 year ago, and that is why we are not doing time proration of the figures of S. And it acquired F Limited in its incorporation date. So meaning that it has been with F Limited for more than 1 year. For more than 1 year. Remember, statement of income only looks at performance of 1 year. Performance of 1 year. So don't tell me if it acquired, why can't you, if it acquired, for example, F 3 years ago, why can't we multiply this with 3? No. Only 1 year. I'm only concerned with the proration whenever it comes to a situation where we stay with a subsidiary for less than 12 months. So from there, ladies and gentlemen, please don't pick your calculator. I'll be able to make some adjustments later. Come and talk of cost of sales. So cost of sales, I'm consolidating, I'm adding. Fortunately, I acquired my subsidiaries more than 12 months ago. So there is no time proration. So for cost of sales, I have 687 plus 228 plus 26.2. So I'll leave space in this case here for what year? For gross profit. I'll leave space there for gross profit. I'm following the financial statements given, right? I'm not doing anything outside. I'm not even thinking at all as I'm doing this. So the next one is other income. So the other income, if you look at the other income, I can see dividend received. So I'll come and just write there, even without reading much, I'll write dividend received. So for dividend received, what do I have? I can see I would want to consolidate. Dividend received is 8.100 the others. So 8.1. So dividend received is 8.1. After 8.1, I'll be able to get there the operating expenses. Operating expenses, what do we have there? Operating expenses, just consolidate them because they've been given line by line. So we have 68 plus 54 plus 13.4. Don't take your calculator yet. Don't take your calculator yet.
Excuse me?
Yes.
Other income is 6.1.
6.1.
Yeah.
Other income. Yes. Or other income is 6.1. And then we have dividends received, 8.1. Right? So I'm being told that the other income is 6.1. And then we have dividend received 8.1. In most cases, the dividend received will be falling under other incomes. Maybe typing error, but let's just go on with it. So we have operating expenses like that. From there, we go to the next thing, which is a finance cost. So finance cost, what do we have there? I'm consolidating. So finance cost, ladies and gentlemen, finance cost, I have 12. I have 18. I have 6.2. From there, ladies and gentlemen, we have the profit before tax. This one, of course, I will need a calculator later. After profit before tax, I have the income tax expense, income tax. So the income tax, I'm simply putting them together. I'm consolidating. Income tax is 45. I have plus 30, and then I have 3.2, right? And then of course I'll have what we call profit after tax. 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 So this profit after tax, once you get this, you'll be able to deduct what is attributable. You deduct what is attributable, what is attributable to NCI. What is attributable to NCI, you'll be able to really get a working for that. And then now you will be able to get the group profit. You'll be able to get the group profit after what year? After taxation. You'll be able to get the group profit after taxation. Please help me out when a student asks a question there about question number and whatever, right? Now, after getting this group profit after tax, of course, we have what we call comprehensive, what year? Other comprehensive incomes. Under other comprehensive incomes, what do we have? We have gain on revaluation of property. We have gain on revaluation of property. Gain on revaluation of property. The person who taught me this told me one simple thing, that anything that falls under comprehensive incomes is a free mark. Other comprehensive incomes, normally is a free mark. What are you supposed to do for other comprehensive incomes? Like other comprehensive income, like now this gain on evaluation, you'll take the one of the parent. The figure of the parent is 15, right? And then we have the subsidiary. The first subsidiary here is S, which is 12. Remember, for other comprehensive incomes, we don't use time apportionment. For other comprehensive incomes, these are free mark. We normally take the figures of the subsidiaries and then we multiply them with our shareholding. And that is only applicable to other comprehensive incomes. A free mark, we have an other comprehensive income and a gain on revaluation. So I'll take the 15 plus, do we know the percentage of S? Do we know the percentage of S? Do you know the percentage of S? Percentage of S, please talk to me. Do you know the percentage of S? 0.6. So 60%, 0.6, thank you very much. Plus the revaluation, gain on revaluation of F, which is 2 there. So 2 times, do we know the shareholding in F? From note number 1 and note number 2. Note number 1 and note number 2 to be consistent, then this will be 90%, which is 0.9. Ladies and gentlemen, remember, I'm just here not to complicate your life. I'm just here to make your life easier, to show you how you can harvest what we normally call low-hanging fruits. Low-hanging fruits. And the very first low-hanging fruit that I would want everybody to understand here today, ladies and gentlemen, is this thing here. All these items here that come after other comprehensive incomes. What do you do? Like now we have a revaluation gain. This revaluation gain, take the parent figure the way it is. That one you don't apportion it at all. Plus the first subsidiary's figure, which is 12. But now the subsidiary, we only recognize other comprehensive incomes. We recognize our percentage only. So plus 12 times 60%, plus in this case here 2 times 90%. Actually, this one you can even take your calculator. These are free mark. Could you kindly give me this figure? Kindly give me this figure. So Lokaya ananiambia ni 30 what year? Lokaya ananiambia ni 33 like that. Sasa wakati umesha set up your initial structure like that, ladies and gentlemen, now you can go to the notes. Now you can think about calculating goodwill, get impairment. For example, in your goodwill bring impairment, of course, will affect our income statement. But trust you me, from my experience that I have with financial reporting, once you have set your initial structure like this, Even if the examiner was to, in this case here, blow a whistle and tell you, you are left with 5 minutes. If he tells you you're left with 5 minutes, what do? You'll pick your calculator and add these figures very fast. And if you do that, trust you me, you can't get a 0. Because there are figures normally, many figures here, which normally, ladies and gentlemen, will never change. Many figures. The worst mistake that I always see students doing, and I don't know who shows them that, is to start with workings. And those workings I'll show you today. I have the marking scheme for last semester. I'll be able to show you today. They're saying page, or page number 20. Is it page or something? I can see a number being thrown there. Oh, not 33. The answer is supposed to be 24. Sorry. The answer is supposed to be 24, not 33. Thank you very much. Now, from there now, I'll come and move now very fast. Thank you very much. I'll come and move very fast and look at what here, additional information, note number 1. And the way I read this additional information, ladies and gentlemen, should be in a very fast way. I should be able to pick things because I know I'm a great scholar of group consolidation, so I know what goes where. So like now we are told note 1, W Limited bought 60%, holding in equity of S Limited on 1st April 2016. The purchase consideration was agreed at 900, of which 600 million was paid in cash. The balance was satisfied by immediate issue of a 5% bond at par. S Limited's net assets at a fair value of shillings 1,400 as at 1st April 2016, represented by equity share capital of 775 million and retained earnings of 625 million. It was decided to apply the proportion of net assets method to calculate goodwill. All that information is so nice, but it'll go towards goodwill computation. Note number 2, W Limited sold its entire 60% equity holding in S Limited on 31st March 2017 for 1150 million in cash. No entry has been made. So of course, when I dispose my shares, there shall either be a gain or what here? A loss. There will be either a gain or a loss, but that will come in later. Don't worry about that. That will come in for number 1. Note 3, W Limited owned 90% of the equity shares of F Limited. Again, that goes to goodwill, whatever. Note 4, during the year ended 31st March 2017, W Limited sold goods to F Limited for 15 million. These goods were sold by W Limited at a markup of 50 million on cost. 3/5 of these goods remained in inventory of F Limited as at 31st March 2017. An amount of 4.3 million remained outstanding to W Limited in respect of these goods as at 31st March 2017. This amount of 4.3 which remained outstanding, which F Limited is claiming it owes W. That is what we call an intra-owing, an internal owing. I told you last time, if for example, I'm to wake up this like a day, even say tomorrow morning, and then my madam tells me, mzee nipatie shilingi 50,000. Kama niko nazo nikimpatia, that is a family owing. Kama for example, nimekopesha mwanafunzi hapa kama Ben Kimani, niambie nipewe 30,000, I expect Ben Kimani atanirudishia, ni friend. Mbona atanirudishia? Lakini bibi yangu, hiyo pesa atanirudishia. So if in my income state, or rather my balance sheet, I have that as a liability, that is a fake liability. That liability must always be deducted from the group, in this case here, current liabilities. Right? It's a fake liability. So this one here will not affect me in the income statement. That 4.3 million will not affect me in the income statement because that is a statement of financial position thing. But now let me go back to note number 4. During the year ended 31st March 2017, W Limited sold goods to F Limited for how much? For 15 million. Remember, W and F are in a very serious relationship. This family. And if it's family, if you have your daughter, if your daughter comes to your shop, assuming you have a shop that sells very nice clothes, if your daughter comes to that particular shop wanting to buy goods, for sure huwezi kumuuzia. Hata kama utasema kwamba I made a sale of 2,000 shillings on this day, memwandikia like that. At the end of the year, when you are looking at your things now in context, you will come and remember that that 2,000 sale that I booked is a sale to my daughter. That is a fake sale. I need to come and deduct it. Ladies and gentlemen, remember that intra-sales should always be deducted from the group sales and the group cost of sales. So come to the group sales here and you subtract 15 and the 15 there. What have I said? I've just said something very nice. That the very first thing that you should always know, look for when you're looking at group income statement is this. If there is any intra-sales, intra means internal. If there is any intra-sales, what should you do? Always go to the group cost of sales, subtract, and the group cost of sales, subtract. Now somebody will wonder, why are we subtracting this thing twice? It's because, ladies and gentlemen, of the relationship between purchases and the sales. One company is saying, I made a sale. On the other side of the coin, the other company is saying, I purchased. And this company saying he purchased is a relative. And the purchases are normally found in the cost of sales. So it means that the cost of sales is overstated. Listen and listen and listen and listen to me very well. Whenever you hear of intra-sales, what should you do? Intra-sales must always be deducted from the group sales and, ladies and gentlemen, the group cost of sales. And then straight away now, as a scholar of group consolidation, I'll have to recall very fast that whenever there is an intra-sale, there must be UPS. So write for me there, UPS, UPS. UPS stands for what in full? 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 UPS. UPS is unrealized profits on what year? Stock. Thank you very much. Unrealized profits on stock. UPS is unrealized profit on stock. And how do I calculate this? As a student who doesn't want to waste time at all, to get UPS, we normally take, in this case here, profit margin times remaining intra-sales. Times remaining intra-sales. Yes, thank you very much, Jacqueline. So anytime they want me to get profit and realize profit, I'll always take the profit margin. Always take the profit margin. Profit margin times remaining intra-sales times remaining intra-sales. These guys, instead of giving me profit margin, they gave me profit markup. They have given me profit markup, and they have told me that the profit markup is 50 over 100. They've told me profit markup is 50 over 100. They've told me that profit markup is 50 over 100. 50 over 100. What they've told me, if you read note number 4, they've told me here that these goods were sold by W Limited at a markup of 50%. And of course, you and I know that we rarely make use of markup in group consolidation, because they won't give you cost of their goods. In most cases, they'll give you the sales. So in group consolidation, we always prefer margin. We always prefer the margin. We prefer the margin. So if this is 50 over 100, of course, we know that margin has a bigger denominator. Margin has a bigger denominator. And how do we get this bigger denominator? You will take the numerator, which is 50 over 100. You add the numerator down. Margin has a bigger denominator. Margin has a bigger denominator. So then this will be 50 over 150, which will be the same as what here? Somebody? A third. Which will be the same as a third. Thank you. So profit margin is a third. Profit margin is a third. Times remaining intra-sales. Times remaining intra-sales. So first of all, are we together up to here? 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 Margin has a bigger denominator. Thank you very much. margin has a bigger denominator. So once I've gotten this margin, then to get now unrealized profit on stock, I'll take the margin I've gotten times REES. Times REES. REES means remaining internal sales. Remaining intra-sales. Sio sales, sio internal sales, sio 15. Okay, itakuwa a third times 15. Lakini utapata at times ile kampuni ambayo iliuziwa hizi goods already imeshauzauza kitu hapa. Unaona? So at the moment these goods are found their way to third parties, if they find their way to third parties, then automatically when these goods go to third parties, we realize the profit. But if these goods are still within the group, then there will be an element of the company that sold. The company that sold must be having what we call unrealized profit. So they must give us a policy regarding the goods which were remaining, not all the interest sales, but remaining. There is an R in front there, remaining. What they've told us here is that 3/5, which is 3/5 of these goods remained in inventory. So whatever we have here times 3/5. This is what you have seen a student giving me a UPS of 3. A UPS of 3. Can somebody confirm? A UPS of 3. A UPS of 3. A UPS of 3. Yes. And remember, even if I go cram, when you have UPS, what do we normally do with UPS? Can somebody talk to me? What do we do with UPS? What do we do with UPS? What do we do with UPS?
You add to the cost of sales.
You do two things. You add to the cost of sales, and in the balance sheet, in the statement of financial position, you subtract it from inventory. If you are doing a statement of financial position, know that your inventory has been overstated. Your inventory has not followed what we call International Accounting Standard 2, which tells us that we should never have profit. We should never have profit in our stocks. But now, luckily, here we are not doing an S of, we are not doing soft here. We're not doing soft here. Here we're only doing an income statement. And as the lady has told us, add to the cost of sales. Add to the cost of sales. So come to the cost of sales. Unasema plus what? Somebody there? Plus 3. Add the cost of sales. No, unasema plus 3. Very good. And I can see so many students who watched my video there. Very good, very good, very good. That is my approach. That's my approach. Thank you very much. Thank you very much. So the 4.3 will not affect us anywhere. Now, can we proceed to note number 5? 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 Note number 5. Note number 5. So note number 5 tells us that on 1st March 2017, F Limited, who is our subsidiary, declared a dividend of 9 million. Could you kindly remind me what percentage of F do we own? W, what percentage of F does it own? W, the parent, 90%, isn't it? So it means that if F declares a dividend of 9 million, then automatically, W will get 8.1. Because you see, W is an owner of 90% of F. So 90% of that 9 declared, that gives me 8.1. Now the question is that 8.1 a genuine dividend? If, for example, today I was to invest in my son, like now we are training them, even you guys have sons and daughters, like now you are training them. Of course, you are investing in them. Would you expect them to give you dividends in the future? Are there dividends they will come to give you in the future? Are there dividends that will come to give you in the future? No. If you want to become a very frustrated parent in the future, think that you're investing in your kids so that they'll come to give you what? Yes, something in future. That is wrong. This is a related party. Hakuna any obligation on them to help you. And the moment you start putting your expectations like that, utaacha kujenga pension yako. The same with group accounts. If there is any income of the form of dividends that you have recognized from your subsidiaries, that dividend is fake. So please go to the dividends that you have there. Please go to the dividends that you have there. You say minus what? Yes, it is even the dividend that this guy had recognized. So you say minus 8 point what? Yes, somebody. Minus 8.1. minus 8.1. So are you seeing under dividends, if you have a column, sorry, my handwriting is very bad, and that's why I don't teach FR. Are you seeing in this case here, under this column here, under dividends received, you will have 0? Are you seeing you'll have 0? How did I get 8.1? Very easy. You know F. Look at note number 3. W Limited owns what here? 90% of the equity shares of what here? F. And whatever dividend F then declares, W will be getting 90%. So 90% of the 9. Remember, we are told in note number, we are told in note number what? In note number, we are told in note number 5 that F declared an interim dividend of 9 million. So are you able to see how I got the 8.1 Winnie? Are you able to see how I got the 8.1 Winnie? Because 90% of 9 is 8.1. 90% of 9 is 8.1. Yes, that's Ruth who has answered. It's Winnie who asked the question. Winnie, are you able to see the, how do you think this is now obvious? If we had any other dividends from third parties, companies that we don't own at a subsidiary level, then straight away I would have recognized that particular what you did. But this is dividend coming from our son. Dividend coming from my son, I wouldn't really want. Remember, if I've ever taught you before, you know that this mwalimu even does not like this thing of dowry. This thing of telling these young people to pay you dowry of 3 million. Hapo ndio shida hata ndoa zinaanzianga sana. Ikiwa ni mzee kama mimi, I told you this story nikifunza FM, mzee kama mimi can afford to pay 3, hata kama madeni taomba. Lakini sasa kijana mdogo, sasa kijana 27 years, atoe 3 million dowry. Akuja achukue 4 million afanye harusi. 7 million. Huyu jamaa ameanza mashida. Right? So those are things in this case which are within the family, which should be knocked off in the context of what here? In the context of group consolidation. Those are useless things. Fanya the Muslim way. Muslim atakwambia kama Jabir atakwambia wazazi wa msichana, wazazi wa mvulana, mnachangia vijana wadogo waenda waone waanze maisha. Wakienda wafaulu huko mbele wapatie kitu, sawa. Wasipokupatia kitu au ulianza kuchunga mapema, pia sawa. Maisha inaendelea, maisha inaendelea. Note 6, all expenses and gains are assumed to accrue evenly throughout the year. No new equity capital was issued by any group company during the year, ended that interest on the 5% bond was payable in arrears. No payment had been made or provided for. No payment had been made or provided for. What do you think of this interest? Remember when W was acquiring, ladies and gentlemen, when W was acquiring this particular company, they gave them some money. We are told the W Limited bought 60% holding in the equity of S Limited on 1st April 2016. The purchase consideration was agreed at 900 million, of which 600 million was paid in cash. The balance was satisfied by immediate issue of a 5% bond at par. A 5% bond at par. A 5% bond at par. When we issue a bond, what does it mean really? Please let us try to understand this thing of issuance of a bond. As RCM, if we need in this case here money, what will we do? Of course, one of the ways is to, if you are a big corporate, we can just make these papers very nicely and then we issue a bond. So when we issue a bond, we expect, of course, the bond holders now to give us what? To give us money. So the question is, ladies and gentlemen, this money that we borrowed was given to our subsidiary. I don't know what your understanding is about this. Will this be an internal arrangement or it's an external arrangement? Remember, we borrowed money, 300, right? 300, which was used in an acquisition of who? Acquisition of our subsidiary. Lokai tells us, even Ruth tells me, that this is an extra, we issued bonds to external people, who gave us 300 million. Because in total, this subsidiary was worth 900 million. But we could only afford how many millions? 600 million. So we had to top up. We had to raise money from outsiders. So it's an external bond. So if it's an external bond, ladies and gentlemen, for purposes of consolidation, then we have to consolidate this money. This 300 million has to go to the group bonds. In the statement of financial position, that 300 million has to go there. And the interest out of it has to go to our income statement. So could you kindly give me the interest here, now that we don't have, ladies and gentlemen, now that we don't have this statement of financial position here, could you kindly give me the interest payable there? Give me the interest payable. The interest payable. It is 300 million. And the percentage is what here, somebody? The percentage is 5%, isn't it? The percentage is 5%. Already people have given me 15. Thank you very much. 15 million. So remember, interest is a finance cost. Go to the finance cost and put that 15 there. Go to the finance cost and put the 15 there. Go to the finance cost and put the 15 there. Interest is a finance cost. I've seen even when you are marking this kind of a thing at KASNEB, you'll get people arguing, but this is money that you borrowed for who? Your subsidiary. But who did you borrow this money from? Who did you borrow? You issued a bond as a parent company. So you borrowed this money from outside sources to enable you acquire a subsidiary. Right? Right? There is somebody in this case here who is not muted. Try to point them out so that they can remember to mute. Very good. Now, ladies and gentlemen, we move on to the next thing. Interest on that one already we have been able to account for it. So, ladies and gentlemen, even before anything, I would want us to get most of these things. Okay, this question I'm quite aware there will be really no impairment. So then what I'll do, I'll come and get my calculator and get these figures very fast. There is no impairment, I'm told, up there. Otherwise, I would have calculated impairment first. So it's a straightforward one. So please go ahead and give me these figures very first. Go ahead and give me these figures very first. So we have here shillings. We have shillings. I'm waiting to get these figures from you. So like, what is the consolidated revenue? 1444, quite a beautiful figure, 1444. Go to cost of sales. What is the consolidated cost of sales? Consolidated cost of sales. Consolidated cost of sales, 929.2, 929.2. Then we have our gross profit, beautiful gross profit, beautiful gross profit, beautiful gross profit. Please subtract there, give us the beautiful gross profit, 514.8. Do we have other incomes? Yes, these other incomes, no adjustment at all. Do we have dividend received? Of course, this will be zero. This will be zero. That will be zero. Give me the consolidated operating expense. Give me the consolidated operating expense. Consolidated operating expense, 135.4. You close like that because that's an expense. From there, we have finance cost. Finance cost will give me how much there? Finance cost will give me how much? Finance cost consolidated, put it together. Finance cost consolidated, put it together. Somebody is giving me a figure of 107. Remember, it is 68, 54, and then we have operating expense 68, 54, 13.4. No, finance cost. Sorry, finance cost. Na nasema ukweli. Finance cost, what do we have here? This is 12, 18. This is 6.2, not 62. Please use your figures. Don't use my figures. My handwriting is the worst in this world, but at least I have something which encourages me that very bright people have what here? Very bad handwritings. No, I'm joking. How I wish I would have a very good handwriting. How I wish I would have a very good handwriting. Very good, very good, very good. Now, ladies and gentlemen, of course, in this case here later on, we would want to get that gain out of what here? Our sale of shares. Would want to have that gain out of a sale of our shares before profit, or rather before this. Yeah, so you can just mention here gain on disposal of a subsidiary, because it was a full disposal of a subsidiary like that. So always tafuta profit before tax hizi. So kuja hapa mnipatie income tax. Income tax inakuja ngapi? Income tax, nipatie income tax. Nipatie income tax, nipatie income tax, income tax. Nipatie income tax. Wanasema income tax ni 107. Income tax expense. Kumbuka ilikuwa ni 45 plus 30 plus 3.2. It's like most of you don't have this question, because you are copying my figures. You're copying my figures. You're copying my figures at your own risk. 78.2, Aha, usubtract mambo mengi sababu katikati uko na maneno. Kwa income tax uko na kama maneno hapo. So usikatafute ati profit after tax, hapana, achana na hiyo. Haya, usikatafute pia hii, utakuja kupata baadaye. Group profit after tax utapata baadaye. Gain on revaluation, you guys are giving me this gain on revaluation. You are given gain on revaluation. Kama ngapi somebody? This other comprehensive income. Other comprehensive income ulikuwa umeshanipatia kama 24. Now, ladies and gentlemen, here we now move. Even if I leave this question that way, where kwa exam nikuuliza swali vile tumefanya tukiwacha hivyo, don't you think ukienda nyumbani you will be happy student after exam? Ukifika paka hapo mahali tumefika, don't you think you will be happy as a student? Ruth anasema 5 marks. Don't you think you will be happy as a student? Hata ukifika hapo useme sasa umewacha kila kitu, wacha iende namna hiyo, you'll be happy. Trust you me, utaenda mbali. Sababu wanafunzi wengi bado wanafanya ile mati accounts. Now, ladies and gentlemen, let's jump to number 1. Number 1, they want us to give them the gain or loss on disposal of shares. Remember note number 2. Note number 2, ladies and gentlemen, they told us that W Limited sold its entire 60% equity holding in S Limited at the end of the year. At the end of the year. You are fortunate, otherwise would have really done quite a lot of the corrections here, because here you are very correct. The disposal, in this case of the subsidiary, happened at the end of the year. So it means that the income of the subsidiary up the end of the year is ours. Correct. So we did this disposal at the end of the year, and it's a full disposal. It was a subsidiary, sold 100%. They sold everything that they had in that subsidiary. Whenever there is ladies and gentlemen, whenever there is a subsidiary that has been sold, it will be very important for you to get goodwill of that subsidiary for us. So give us goodwill of the subsidiary. Give us goodwill of the subsidiary. Give us goodwill of that subsidiary. Even if I rub, you guys will know what to fix. Even if I rub, you guys will know what to fix. So ladies and gentlemen, here we are. Disposal of a subsidiary. The very first thing you need to do is to come and give us the goodwill of the subsidiary. Goodwill of the subsidiary. Give us the goodwill of the subsidiary. Give us the goodwill of the subsidiary. For you to be able to give us the goodwill of a subsidiary very easily, start by giving us the net assets of that subsidiary. So net assets of the sub. Remember we said we're using the equity way, and you guys are the ones who gave me the equity components, right? You gave me the equity components very fast. Equity components, mkaniambia equity components ni kama gani na gani kama nakumbuka equity components. Niko peke yangu. Equity components mliniambia kama ordinary share capital, you guys are bright. Ordinary share capital, yes. And remember, just for purposes of getting goodwill, I only need at acquisition, at the date of acquisition, natosha peke yake, at acquisition, because we are computing goodwill at acquisition. So kuna ordinary share capital. Nini ingine tena tunajua? Kuna share premium. Thank you very much. I can even write all of them. Share premium. Nini ingine ambayo tunajua ni part of equity. Kuna retained earnings. Kuna retained earnings. You guys are bright. Retained earnings. Nini ingine tena somebody? Revaluation reserves. We normally call this fair value adjustment. We normally call this the fair value adjustment. We normally call this the fair value adjustment. Thank you very much. So, hebu tuangalie tuende pole pole. Tunaanza na ordinary share capital. Ordinary share capital, remember we are talking of which subsidiary? We are talking of S that was sold. Ordinary share capital of S at acquisition ilikuwa ngapi? Kuna mahali wametupatia kitu ordinary share capital. Kuna mahali wametupatia equity share capital on 1st of April 2016. Kuna mahali wametupatia kwa mwisho before additional information. Kuna mahali wametuambia equity share capital 1st of April 2016. Wamesema ni ngapi somebody? Remember that is when we acquired. That's when we acquired S. We acquired S on 1st April 2016. Share capital. Wamekwambia kwa chini kabisa equity share capital ilikuwa ni 700 and what here somebody? 775. Hakukuwa na kitu kama share premium, hata fair value adjustment haikukua, right? Lakini tulikuwa na retained earnings at acquisition. Are you able to see the retained earnings at acquisition? Retained earnings at acquisition. Wamekuambia hapo jameni. Kuna mahali wamekuambia kwa additional information. Additional information wamekuambia that S Limited's net assets had a fair value of shillings 1400 as at 1st April 2016, represented by equity share capital of 775 and retained earnings of 625. Kumata amenipatia total figure. So 625. So hebu niongeze hizi mbili zinakuja ngapi Woye niongeze hizo mbili, hakuna hata vitu mingi, 1400. Great. So nakuja namwandikia hapa goodwill on acquisition. So namwandikia hapa kwa furaha. And some of these things, ladies and gentlemen, ukifanya some of these things, ladies and gentlemen, unafanya kama una smile, unafanya kama unacheka. Ile mahesabu haitaki makasiriko. So goodwill, of course nishakufunza tayari hii. Tukasema utakuja useme parents. The parents consideration. Parenti alipeana pesa ngapi? Alipeana 600 cash na akapatiana 300 million in the form of a debt. But fortunately, that money was paid immediately. How I wish a good examiner angekwambia there was an arrangement where these people were given shares with a promise to pay for them 1 year later. So if that was the case, of course, they must give you cost of capital. If that was the case, what would have you done? What would have you done? 900 will be paid later, right? After 1 year. So what do? You apply financial management. Yeah, you discount, isn't it? Discount, right? And then, of course, at the end of each year, you must look at what we call the unwinding discount. The unwound discount must always go to where? The income statement. That is a very important concept which you guys need to be good in. So in this case here, we have the parents' consideration, unaandika 900. Alafu unakuja unasema, remember the parent never bought everything. NCI's consideration, kwanza unawacha mark, space, ujue kama ni, very good. So unakuja unasema hapa total consideration. So total consideration, kwanza unaiwacha. Unakuja unasema hapa chini woye, less net assets at acquisition. Are you able to see the net assets at acquisition? Net assets at acquisition ndizo hizi. Ni 1400. Hiyo ndio net assets at acquisition. So unatafuta fair value ya NCI. Na kama fair value hakuna, kama fair value gotire, unakuja unatafuta straight away the proportionate. Remember here we own 10%. NCI has 10%. NCI has 10% because the parent owns, no. The parent in this case here owns 60%, sorry. The parent owns 60%. The parent owns 60% of S. So then NCI must be owning what percentage here, somebody? NCI must be owning 40%. Remember, it's S that we're talking about, not F where we have 90%. So, ladies and gentlemen, if that is the case, please look at this particular note, which is talking about proportionate method. There is a place they have told us about proportionate method for NCI. Is there anybody who is able to see that thing anywhere? Yes, still in note number 1, it was decided to apply the proportion of net assets method to calculate goodwill. So, ladies and gentlemen, it means that it is the NCI we are getting their proportion of net assets. And their proportion of net assets here for NCI, it will be 40% of 1,400. 40% of 1,400, that will give us what figure, somebody? I want NCI's proportion of net assets. Wananiambia wote ni 560. Kwa hivyo so ukiongeza 900 plus 560, itakuja ngapi, somebody? 900 plus 560, itakuja ngapi, somebody? Itakuja ngapi, somebody? 900 plus 560, itakuja ngapi? 1460. Somebody is telling me 1460. Somebody is telling me 1460. So then come and subtract the net assets like that for you to be able to give us goodwill at acquisition. Goodwill at acquisition. Goodwill at acquisition. So goodwill at acquisition, which will be what here, somebody? Which will be 60 there. Goodwill at acquisition will be 60. Goodwill at acquisition will be 60. So is that okay? How do you get 900? Thank you very much, Ruth, for the question. How you got 900? Look at note number 1. W Limited bought 60% holding in the equity of S Limited on 1st April 2016. The purchase consideration was agreed at 900. 900. 600 paid in cash. The balance we had to borrow. So are we together there, Ruth? Are we together there, Ruth? And then, of course, there is no impairment. There is no impairment. So goodwill at reporting is what here is 60. Goodwill at reporting is 60. They have told us in this particular note, before note 2, no impairment loss on goodwill arose during the year ended March 2017. 2017. Great. So that is the first thing you should do whenever you are told that there is a disposal of a subsidiary. Either you've disposed it fully, or you are moving from control to no control. I mean, I had 60%, I sell 30%. If I sell 30%, then I'll be left with what here with 30%. You see, 30% is an associate. So I'm moving from subsidiary to an associate. That is what we call movement from control to what here, somebody? To no control. So that one, you need goodwill. That one, you need goodwill for purpose of getting what here the gain or loss on disposal of your subsidiary. But if it's from control to control, anyway, let me not confuse you quite a lot. That is the first thing. You know, here we are losing actually the entire subsidiary. We are losing the entire control. We are losing the entire control. Great. So come here, ladies and gentlemen. So after that, now I'll come and write a note there, gain or loss on disposal of the subsidiary S. Gain or loss on disposal of S. Gain or loss on disposal of S. Gain or loss on disposal of S. Now, the very first thing that you need to do, whenever a subsidiary is disposed is to give us the net assets of that subsidiary at disposal. You give us the net assets. The first thing you need to do, come and give us the net assets of the sub at disposal. So the net assets of the sub at disposal again, for purpose of you just getting this thing, ladies and gentlemen, for purpose of you getting this thing very well, just know that net assets you're using equity. And you get used to the fact that you're supposed to be having ordinary share capital, you're supposed to be having share, because the questions you'll be getting, you'll be having these things, you're supposed to be having retained earnings, and of course, at disposal, at times there are some fair value OT adjustments, because you have to call some valuers. It's important you call in some valuers. Yeah. So in this case here, the subsidiary that is being disposed, what is its ordinary share capital at disposal? It was 700 and what here, somebody? 775 at disposal. Remember, ordinary share capital of subsidiaries don't easily keep on fluctuating. I'll be showing you, especially for those who are in section 6, I'll be showing you how the ordinary share capital of this subsidiary is 775. Ikitu share premium. How about retained earnings, ladies and gentlemen? Retained earnings at the date when this subsidiary was being disposed. Retained earnings at the date when the subsidiary was being disposed. Retained earnings as at when you were disposing this. HP anasema 625. That's quite a good try. But remember 625, my brother, I hope this is a brother, 625 ilikuwa ni 1st of April 2016 when you were acquiring it. And retained earnings normally grow with profits. Retained earnings normally grow with profits. Retained earnings normally grow with profits. Kumbuka 625, I'm in agreement with you, 100% by the way. 100% by the way. 625, 100% by the way. 625, this was retained earnings at acquisition, 1st of April 2016. But remember, we sold this thing on 2017, end of the year. 2017. Thank you very much, Jacqueline. Jacqueline ameshaona tayari inafaa ikuwe 625 ile ambayo tulianza nayo plus the profit for the subsidiary. That is the total comprehensive income for the subsidiary. For the subsidiary for the year, which was 102. Which was 102. Remember, this subsidiary never declared any dividend. So it's assumed that the entire profit is retained. It's assumed that the entire profit is retained. Hapo sioni kama tumeelewana. Hapo sioni kama tumeelewana. Hapo sioni kama tumeelewana kusema ukweli. Hapo sioni kama tumeelewana kusema ukweli. Because the most important thing is for you to mark the date when you disposed this thing. Mark the date when you disposed this thing. We disposed this company at the end of 2017, or rather at the end of this financial year, 31st March 2017. And when you look at the retained earnings account, you're able to see there, retained earnings we came with plus this 102 comprehensive profit. Where did you get this 102 from? The total comprehensive income for the year for S. Aniva, ewangalia comprehensive. Ununa mali wameandika total ile kitu ya mwisho kabisa before additional information. Before additional information, are you able to see the 102 comprehensive income of S? Aniva amesema yes. Michael sijakuona, Michael sijakufeel. Thank you very much. So you see that 102, that comprehensive income, right? The whole of it is retained because there is nowhere they've told us that this particular subsidiary gave out any money, right? So that is the entire amount, which is what here somebody, which is retained, 102. So every party figure nakuja ngapi? 625 plus 102 nakuja ngapi somebody? 625 plus 102. Nimeona mwanafunzi akilala na kuona wewe. Mimi nakuona 727. Hapa hakuna fair value adjustment. This was a very simple question. So please come and give me the total net assets at acquisition. The total net assets at acquisition. Jacqueline amestuka sana, sijui kwa nini amestuka namna hiyo. Jacqueline amestuka sana. Jacqueline sijui kwa nini umechora ile macho kali kabisa. Jacqueline, we shall overcome. Life is good. 502 502 502 1502, I mean 1502. Thank you very much. So remember that these are net assets of the company as a whole. For disposal, we are not saying we are disposing the entire subsidiary. We are only disposing our share. So in this case here, come and look at the net assets, the net assets disposed by the parent, disposed by the parent. So the net assets disposed by the parent, this I can double underline, will be 60% the share, its share, 60% of this 1502. Is anybody who is able to give me this figure, 60% of 1502? So already they have a figure of 901.2, 901.2. And then remember vividly what I taught you in CPA section 4, those days when you used to be very young, if you remember. They say young and pretty, right? But even now you are young, especially young at heart. Yes. So remember, profit is revenue minus cost. Revenue minus cost. Revenue minus cost. Revenue minus cost. So profit is revenue minus cost. Ngoja kidogo. Wewe kuna kakitu hapo, kuna kakitu hapo, kuna kakitu hapo, unafaa kujua. We have here the net assets. The net assets in this case here disposed by the parent. Umepata 901 point what here somebody? 901.2. 901.2. 901.2. Remember that these guys also, before I go to the profit, is revenue minus cost. These guys had also an asset which has not been factored in. Sorry for that. These guys had an asset that has not been factored in here. These guys had an asset we call goodwill. So at the date of disposal, they had a different asset which is not here. They had an asset worth how much here called goodwill, worth 60. So therefore their total now assets disposed. Sorry for that. Total assets here disposed. Total assets worth of assets here disposed will be 901.2 plus 60. Please give me a figure. Plus 60. 901.2 plus 60. This will give me what figure? Somebody 961.2, like that. So this is the amount that this company, parent company, had injected into this particular what here. Somebody, this is the worth. Yes. 102 imetoka. Mary anauliza ile 102. Hii 102. Unaona pale Mary, ukiangalia pale kuna comprehensive income. Total comprehensive income for S. Kuna total comprehensive income for S. Total comprehensive income for S. Ukiangalia vizuri ni 102. Kuna 193.12, kuna 102. Kuna 102. Right? Right? So in this case here, ladies and gentlemen, remember profit is revenue minus cost. Profit is revenue minus cost. Profit is revenue minus what here? Minus cost. So what is the revenue? How much were they given for the disposal that they did? How much did they receive? How much they receive? Caroline tells me that in this case here from note number 2, they sold the 60% holding for 1150. For 1150. So the entire revenue they received was 1150. To them, the cost, please never work with the cost which they paid initially, because assets keep on fluctuating, going up, going down, going up, going down, like that. So to them, the cost is these net assets at the disposal. At disposal, which is what here, somebody 961 point what here, 0.2. 961.2, 961.2. Could you kindly give me the total? So gain on disposal, I'm being told it is it's positive 188 point what here 8, which is again on disposal. Again on disposal. Again on disposal. Nataka nirudie kitu vizuri sana. Anytime you're told that a company has been disposed, A company has disposed their shareholding in a particular subsidiary. You've lost your control. The very first thing you will need to do is to give us the goodwill as at the date of losing control. So do a goodwill account. Step number 2, give us net assets of that company as at the date of disposal. How do we get net assets? It's ordinary share capital, it is share premium, it is retained earnings, it's a fair value adjustment. So retained earnings, Mary is asking why add. When we bought this company, we bought it having retained earnings of 625. So this 625 retained earnings at the beginning, the company was not asleep the whole year. It went ahead and made a profit of how much? A comprehensive income of 102. So then by the end of the year, what will be the total retained earnings? Remember, these guys never paid any dividend. So in this case here, at the end of the year, it will be 625 that it came with, plus the 102 which has been retained to become part of that. So I don't know whether, Mary, we are together there. Great, great. So then we have gotten 188.2. Could you kindly take that figure to the to the statement of consolidated incomes, right? Take that figure of gain. Ngoja tuone maajabu ya Musa. Ngoja tuone maajabu ya Musa kama kuna wanafunzi ambao wamemaintain vitabu zao vizuri. Tuone kama kuna wanafunzi wamemaintain vitabu zao vizuri. Kuna mahali wamesema gain on disposal of shares. Kuna kalaini tuliwacha pale. Kuna kalaini tuliwacha pale katika consolidated income statement. Katika consolidated income statement, kuna kalaini ambako tuliwacha mahali jameni. Kuna kalaini ambayo tuliwacha mahali jameni. And if I remember, if I can pick it from somewhere, kuna kalaini ambako kalikuwa na gain on disposal of subsidiary. So ningetaka uniandikia hapo 188 point what here somebody 8. Alafu sasa ikiwezekana sasa pick zile vitu toka juu zote, pick hizo vitu 514, ilikuwa 514.8, 6.1, kwa kuwa na 135.4, kwa kuwa na 51.2. Hizi ni deductible. Na hii unaongeza. Alafu nipatie the profit before tax. Nipatie sasa profit before taxation. Profit before taxation, what do we have here? Profit before tax. Profit before tax. Caro ananiambia profit before tax. Oh, profit before tax. Caro ananiambia at 523.1. Is there anybody who is able to get? Akisiona wanafunzi wakiongea sasa. Aki hapo wanafunzi wataki niwasaidie. Wanafunzi wataki niwasaidie. Wanafunzi wataki niwasaidie. Steve umepata figure tofauti. So long as you are able to remember the gross profit that we got up there, the gross profit we got up there, then we have other incomes of 6.1. We had operating expenses there. We had this 51.2, which is a finance cost, I suppose. And then this one, 88.8, remember, is supposed to be a positive because it's a gain. Ingekuwa loss ungetoanisha. Right? So chukua hii, uongeze hii other income, utoi, uongeze, itakuja 523.1. 523.1. So this 523.1, sasa hebu angalieni income tax. Tax tuko na figures already, ukiziongeza zote, zilikuwa zinakuja 78.2. Hebu confirm. Confirm. Tax is tax 78.2, and if it's 78.2, please, could you kindly give me the profit after what here, somebody? The profit after tax. Please give me the profit after taxation, which is profit for the year, Profit for the year. So profit for the year, remember I promised a present. I should be able to give a present. Stephen ananiambia kwamba hii profit for the year inafaa kuwa 444.9. Give it, so appropriate to NCI, the NCI appropriation kwanza. Wewe unajinyima kidogo, you appropriate to NCI. NCI appropriations, remember NCI kuna S. Na anaweza kuwa nakumbuka percentage ya NCI ya S. Percentage ya NCI ya S. percentage ya NCI ya S ilikuwa ngapi? Kumbuka sisi tuna own 60. So S ni 40%. You guys are right. Na ES ili make profit after tax ya ngapi? Enda kwa S niambie S ili make profit after tax ya ngapi? Enda kwa income statement ya S. Income statement ya S, you'll be able to see profit after tax. Kumbuka hapo tunagawa profit after tax, eh? So usigawe comprehensive incomes. Usigawe comprehensive income hapo ndio 90. Haya, so what is 40%? Remember hakuna mambo ya adjustments hapa ya EPAT. Hii ni simple question. So 40% of 90 gives me how much? 40% of 90 will give me how much? 40% of 90 will give me how much? Aha, Ruth ananiambia kwamba 36. Hiyo itaenda kwa NCI wa S. Na pia tuko na NCI wa F. Tuko na NCI wa F. NCI wa F walikuwa what percentage? NCI wa F walikuwa what percentage? NCI wa F walikuwa ni 10% of the profit after tax ya F. Profit after tax ya F ni ngapi jameni? Profit after tax ya F. Profit, somebody. Usifanya hapo, usifanya appropriation ya comprehensive income. Unafanya appropriation ya profit after tax. So wananieleza kwamba for F it's supposed to be 14. So 10% of 14, that will give me 1.4. So please come and subtract there. Subtract like that for you to be able to give me the profit, the part attributable to the group. Part attributable, part attributable to the group now. So the part attributable to the group, is there somebody who could be having this part attributable to the group? Part attributable to the group inakuja ngapi? 407.5, 407.5, 407.5. After which, ladies and gentlemen, now remember we have something here. We have other comprehensive incomes. Other comprehensive income. Remember, we had already done this figure. If I remember very well, you guys gave me a figure of 24. Other comprehensive income, mlipatia 24, and therefore now we should be able to get the total comprehensive income. The total comprehensive income. The total comprehensive income una add. Wananiambia kwamba ni 471, 431.5. 431.5, like that. Now, wacheni pia niwapatie siri nyingine moja ya group consolidation. Usikawai enda kujaribu kutafuta marks mingi sana. Umeona, kama mimi nafanya, mimi nilikuwa kuna paper ya ACC inaitwa paper P2. Paper P2 global during my time, I was top 100. Right? Globally. And I can assure you, it's not because I know a lot of these things, group consolidation. It's because I have the structure in my mind. Ukishakuwa na structure in your mind, hata naweza nikaruka. Mimi ni mjanja. Naweza nikaruka na nikasema profit after tax for the year. Sinaacha blank kwanza. Nimeruka tu. Nimeruka tu. Nakuja nasema, for example, part attributable to NCI. Nachukua the NCI percentage. Nitaumoma to mark twingi sana. Ukishajua tu approach, it is the question that you need to start with. So I would want to take this opportunity to show you how KASNEB marks questions on groups. Can I do that right now? Ndiweza kupata confidence? Can I do that right now? Nikuonyeshe vile wanamarka questions a group. Great. So then what I will do, badala ya kuonyesha hapa kwa group sababu itachukua time, let me just send it. Yeah, they're asking very good questions. What if it was even if it's a partial disposal, Nicholas, I'll be able to show you there is no difference whatsoever. Hakuna. Wewe kazi yako unajue, are we losing control? Okay. So what I've done in the interest of time, I'll just send you the entire solution kwa group yenu ya last semester. And then the other thing, you guys amuku watch video yangu sana. Aki sijui nitafanyaje. Because sikufikiria inaweza kustrain hata kuifunza. Nilikuwa nafikiria hii ni haraka haraka, lakini vile nimeiona haya. Confirm kama umeona kitu kwa group yenu. Confirm kama umeona kitu kwa group yenu na uangalie swali ya consolidation. Uone vile una mark. Ukienda kufanya T accounts, fortunately most of you mliniambia mnajua pia T accounts. Mliniambia mnajua sana T accounts, ni kweli? Mliniambia mnajua sana T accounts. Yeah. Okay, so I hope you guys have been able to see, and if possible, please, T accounts itakusumbua sana. Usikai fanya anything T accounts. They are no longer, kitambo walikuwa wana mark hizo T accounts. Siku hizi hakuna kumark T accounts hata moja. Nimetuma kwa hiyo group ya section 6 block revision. Group ya section 6 block revision. Block scene, okay? Yes. Hebu tafuta swali ya consolidation hapo, utaona the way wana mark, kama indicate hapo marks. Wana mark entries kwa income statement na entries kwa balance sheet. Hata kwa cash flows ni entries direct. Don't do T accounts. Kwanza ukifanya kwa cash flow T accounts kuna shida. Ruth has not yet seen. Oh. We shall overcome. Veronica au section 3 ndio watumia yenu baadaye. Sasa hii section 6 haitakusaidia. Now for this semester, for those of you who are in section 6, what I'm predicting for group accounts, it's either this balance sheet, right? Or income statement, or kiangalia sana mimi sijui kwa naona hii sijui sana, lakini kiangalia sana hii kitu ya foreign subsidiaries. Hiyo foreign subsidiary mko na shida nayo kweli? Foreign subsidiary, do you have a problem with it? Kutranslate vitu rahisi, ingine historical, ingine average. Is there anybody who has a problem with handling foreign subsidiary? Foreign subsidiary. Hiyo si una cram tu, unajua kama hata kama utapata zote, unajua for example kama haya hiyo unajua for example kama ni income statement, rate gani hutumika sana kwa income statement? Income statement ku translate, which rate do you normally use? You don't have to get all the marks. Average. Hiyo ndio itakuja Daisy wewe. Hiyo itakuja. So what we shall do, because now I can't start anything new then, I will take this like I owe you 1 hour. We stop there. I owe you 1 hour in our next class to fanya 3 hours. But most important, ukitaka vizuri ni kutumia swali kama yanaenda kutumia leo hii ya foreign subsidiary. Please watch that video. Watch the video. Tukija hapa inafaa mimi nakuja kukupatia story. Otherwise hata move vizuri because kama sana nafaa nikuwa nimeenda kwa EPS. Nakuwa nimeenda kwa EPS. Lakini saa wengine muangalie video.